Most people don't think they make enough to put $1 million in their Roth IRA by retirement. But through the last few videos, I've shown you that that's not true. Anybody can build a seven-figure retirement if they're taught the right way. And today, I'm going to show you why people miss the biggest opportunities in the stock market, even when it's staring them right in their face. But first, who am I and how do I know? Well, my name is Aaron Washington. I'm a certified financial planner and wealth manager, as well as a capital markets and securities analyst. I study hard so you don't have to. Most people think that every drop in the market is something bad. They think that red means danger, red means sell, or red means to panic. But the wealthy investors, they don't think that way. And that's because they know how to separate stock drops from sector drops. And if you don't understand the difference between the two, that can mean you panic selling or missing out on opportunities where you can multiply your return. Meaning you could potentially be taking unnecessary losses in situations where there's opportunities for you to cut years off of your retirement. But today, we're going to prevent that. So first, what is a stock drop? A stock drop is when a stock or company's price reduces in value, indicating that there may be something wrong with that individual stock or company. This can come from news, bad earnings, bad management, too much business debt, or a broken business model. And that's not opportunity, that's risk. This is where most beginning investors get hurt. They think the price is down, so it must be cheap. No, sometimes it's down because it needs to be down. Have you ever bought a stock because you thought it was on sale and the price kept going down and you kept losing money? Well, that's why. Now, here's where the wealthy and the future wealthy, me and you, are going to think differently. We're not going to chase stocks just because they're cheaper without finding the news behind it and exactly why they're cheaper. We also don't panic sell whenever we see temporary market declines because we understand the difference between stock drops and sector drops. The wealthy see sector drops as opportunity, not danger. Whenever a sector drops, it's not a single company that's dropping. It's money rotating within that sector. You see, money flows from one asset to another in the market. It never completely disappears. So that means when you see a drop in all tech stocks, money may be going to healthcare sector. If you see drops in the healthcare sector, money may be going to commodities such as gold and silver. These businesses didn't just disappear, and the demand is still there. It's just attention shifted elsewhere. Whenever money moves in a market, there's opportunity for profit in another sector. And the wealthy, they move their money together. So let's be a part of the wealthy and move our money with them. I'm going to show you exactly how to do that. Now listen up, because this is where the long-term investors need to really pay attention. Think about it like this. If every restaurant in your neighborhood is struggling at the same time, is that because all food is bad? No, that's just because there's something going on at the time period where people can't afford to go out and eat. This is usually something temporary and usually returns back to normal. That's an example of a sector drop. And here's the thing to pay close attention to. Historically, sectors that have dropped the hardest have had the highest return whenever the market corrects and returns to normal. That's not luck. That's how the markets work. And you could take advantage of it if you understand how the markets work too. If you're holding a stock and that stock alone is down, but the sector is still up, there may be a problem with that stock. But if the whole sector is down while your stock is down, that may be an opportunity to come in and make more profit whenever that stock returns to normal. This is where cash comes in. If you notice, wealthy always keep cash available in their account for specific reasons, just like this. You don't hold cash out of fear. You hold cash for flexibility. Holding cash lets you buy quality stocks when the prices are lower during the sector decline. It also helps you rebalance your portfolio without having to sell your winners. But the biggest thing is while they're out there seeing the prices drop and they start selling their stocks, panic selling, because they don't understand the difference between a simple stock drop and a sector drop, you could take advantage of the cheaper prices and get those quality stocks at a cheaper price and wait for the prices to go up to take advantage of more profit. This is what the wealthy do. They don't hold cash because they're scared. They hold cash because they're prepared for other people to get scared. And inside of your Roth IRA, this matters even more. Why? Because all growth is tax free. Buying assets inside a Roth IRA doesn't just increase returns, it multiplies your long term outcomes, cutting years off of your retirement. And if you start investing into your Roth IRA late, That means it's not too late for you. Structure beats guessing every single time. You need structure. This is why most people can't take advantage of sector drops because they don't have their Roth IRA set up the correct way. They're either fully invested at the wrong time, they panic sell instead of rebalancing because they don't understand the difference between a stock drop and a sector drop, or they don't have a plan for the cash that's sitting inside of their Roth IRA, or let alone don't have cash at all sitting in their Roth IRA because they don't understand that not all the cash inside of the Roth IRA should be invested in stocks. They should leave some sitting in cash to take advantages of opportunities in the market, like what we were just talking about. This will cause you to react emotionally instead of strategically because you don't have a plan. And here's the crazy part. Most people don't lose money because of bad investments. They lose money because of simple IRA mistakes that they don't even realize that they're making. And that's why in the next video, I'll be going over the biggest Roth IRA mistakes and how to fix them if you already made them. If you got any value from this video, do me a favor and hit that like button and follow How to Hire Your Money to get more investing tips, and share this video on your page to make sure that we spread financial literacy in 2026 to as many people as possible. And if you want to get the checklist to make sure you're keeping up with the videos and keeping up with us and everything, comment sectors in the comment section, and I'll send you a copy of the checklist to make sure you're going down each step to make sure you're setting up your Roth IRA the correct way.